He's a great guy. He's a smart guy. And we have our guest, Michael Pento,
Hey,
Euro
Joe,
Pacific.
thanks for having me back on the show.
Oh, we love having you
I
on.
was cracking up. I couldn't stop laughing. I hope you guys didn't hear me. But
No.
I was listening to Joe Livornia live on CNBC when he was giving that interview, and I was, I had to run to the bathroom and relieve myself on a periodic basis. So the answer is to bulldoze houses. Now, rather than let the market work and let the home prices adjust to a level where people who have saved their money and have been renting and doing the right thing, behaving appropriately, can buy the house, the answer is to bulldoze the house down. Now, I just wanted to scream, doesn't somebody already own the house, like a bank? Now, the bank's holding that house at some fictitious mark-to-model, that loan at some fictitious, or that asset at some fictitious mark-to-model price, which is keeping their capital elevated. If they bulldoze the house down, guess what? Banks are insolvent. Does anybody want to any reality into the minds of these people?
And you bring up a great point. Let's talk about the banks. When they went in March of 2009, and they changed the accounting rules from mark to market to mark to model so they could move the assets up, they're sitting here. This is what I love. They're sitting here with this fake economy, this fake stock market. And here's how I love the way they're building the economy. They first go and say, hey, look, wait a minute, let's change the accounting rules so banks, it used to be banks, I think it was 120 days you're behind in your payment. Not only did you have the banks have to write off the payments, but they had to write off the whole loan, but they changed it now. So now we have these freeloaders. They can stay in our houses for 2 years. And here we're trying to build an economy with the money that the people are saving on their mortgages, their upkeep, their real estate taxes, and they're telling us we have this. And this idiot Geithner says, "Boy, our economy is healing."
Phil, that's how you boost consumption. If you tell people they don't have to pay their mortgages, they can go out and buy new iPods.
Yeah, exactly. I mean, what is it? The more of these people I see on CNBC, I just scratch my head and go, where are these people coming? What are they? What book are they? Where are they getting this stuff?
These are the same people worried about deflation still, Phil.
Yeah, you're right. And
talking about the market, I put up a quick chart just to show. Your listeners can go to Yahoo Finance. They can go to the chart of the XLF. It's a basic chart, XLF, which is the financial sector, and they'll realize that after a year of this booming market, the financial sector has gone nowhere.
Exactly.
It is negative. But then you throw up, say, for instance, the XLE, which is the energy sector ETF. Or if you put up GDX, which is the gold miner ETF, they're up 30% each over the year. So the market is going up, but it's only the commodity prices that are going up. And if you want to invest in the stock market, you have to invest in stocks that pull these hard assets out of the ground. Don't squander your money in the Citigroup or in the XLF. You're throwing your money away.
It's the minings. We've had our gang in the mining stocks for a long time, especially gold and silver. But look, what's interesting. Let's go back to these banks for a moment, because it was interesting when J.P. Morgan comes out, Citi comes out, and they're starting to use the reserves to pump up their earnings. And they don't have quality earnings. I mean, how long is this charade going to go on? That somebody's finally going to come out and admit these banks are insolvent, and this whole charade, these banks to lead the market higher. Like you say, if you look at the banks, and it's really funny,
gone nowhere.
They're gone nowhere. And the biggest asset that people have, housing, going down, while the stock market, with all the fake rallies, are going up. Doesn't anyone figure out, wait a minute, how can the stock market's going up, but the biggest assets that people have is going down, and then you get an idiot like Gartner saying it's
going up in nominal terms. If you want a real return, you got to buy the XLE. You got to buy the GDX. They're up 30% year over year. Inflation's running at almost 10%. So here's the stocks giving you a real return. Are you getting a real return putting the money in the bank with Bernanke's 0% interest rate policy? Not at all. See, the whole idea here was that Bernanke decided, since he's in the pocket of the big banks, in order to bail them out, in order to keep their capital ratios high, he's got to bail out the housing market and the real estate sector. So what do? You create a whole hell of a lot of inflation. But here's the surprise to Bernanke. All of that new money isn't going into a bubble that just burst. It never does. Look at the NASDAQ. Mm-hmm. We're about 40% below where we were in the year 2000.
Exactly.
New money created never goes into an old asset bubble. It's going into commodities and to precious metals where it'll always go. And that's where you're getting a real return on your assets.
Yeah, last year, all year, right up to even now, we've been in PAS, P-A-A-S. We've been living with that stock for over a year, and you're so right. Let's talk about inflation. Let's talk about China for a moment. This is interesting, China. So China's inflation is at 5.5%. I think their GDP is, 9% for the quarter?
Over 9%.
Over 9%. Now, here's the interesting thing. China... They're holding about $3 trillion of our
$2 trillion in U.S. Treasuries, $3 trillion in currencies.
Okay, now they're going to have
that's just all of, they all hold other currencies.
Now they're going to have to come up with a decision here. Now their people are suffering inflation. Their prices are going up. Wait a minute here. At some point, I mean, they've been keeping our economy up. They've been holding our economy. At some point, aren't they going to turn around and say, "Wait, we got to make a decision. Are we going to keep holding up the U.S. economy, or are we going to take care of our people?"
So, if you look at the tick data, it clearly shows that China stopped buying U.S. debt.
Exactly.
They finally wisened up. And most of their debt is on the short end of the yield curve, so they can always roll off that debt in just a few years.
Exactly.
They've stopped supporting our phony economy. They've stopped squandering their savings into our debt market. Listen, if I was a Chinese holder of U.S. debt, I'd be pretty nervous right now. Interest rates are rising, which means the value, the principal of that debt is falling, and the currency that I hold it in is crashing. Does that sound like a very good deal for me? I mean, I know Geithner thinks that it's somewhere in the Bible says very explicitly that the U.S. dollar, that's the commandment number 11, the U.S. dollar will always be the world's reserve currency. Therefore, we can keep interest rates at zero and print money and counterfeit money like Al Capone. And the dumb Chinese will never do anything about it. And neither will the Japanese, and neither will the Europeans. But we're heading for a dollar crisis and a bond market crisis, while Geithner is telling you that things are never better than before.
Exactly. And when you look at it's amazing. When you look at the dollar against all the other currencies, I mean, take the Colombian peso. That's what that's what 44%. And then you take the ruble, and I mean, if you really, this is amazing what's going on.
But Phil, isn't that what we need? Isn't that what we need to destroy our currency, to boost manufacturing? You see all those manufacturing jobs that we've created in the last few years? Gee, manufacturing as a percentage of GDP has gone from 28% in 1953 to 11% of the economy. So no bull dinky, nobody's coming on this show and telling you, well, that's because of productivity. I didn't quote you how many people are working in the manufacturing industry. I said what percentage of our economy it is. Our manufacturing base has been decimated. Go around your house and turn things over, and you'll see made in China, made in Indonesia, made in Korea. Nothing is made in the United States anymore. That's why our people can't get good jobs. They get fired from Wall Street, and they go right onto the McDonald's fast food chain line. And that's why real wages are falling in this country.
And also, too, take like today, yesterday we had Intel, and the market's rallying off Intel, and the weak dollar. They keep on. Every time I listen to CNBC, I get so mad because they keep telling us how wonderful the weak dollar is because it takes care of all the companies that would go overseas. Hey, wait a minute. But the weak dollar to me is associated with Congress having no discipline, no spending constraints. It causes higher capital costs for a small business, higher taxes, higher commodity prices, more regulations, and but Intel, because of the weak dollar, they had great numbers. Our country's doing great because of Intel.
Yeah, well, the country's doing fantastic, although the dollar, they think they're making so much money in dollars once they repatriate their currency back into dollars. But guess what? The dollar doesn't buy anything anymore. Does that worry any of these people in Washington? I mean, the same process that destroyed the dollar, if you look at it against the Canadian dollar, against the Australian dollar, the same process that's wiping out the currency is the one that has sent commodity prices up 30% year over year. It's the same process that sent import prices up 9.7% year over year. It's the same reason why your real wages are plummeting.
Michael,
and why the middle class is getting destroyed. But golly gee, Intel's doing great.
Quantitative easing. Are we going to have QE3, QE4, QE5? Is there enough trees? We're going to find that out from our guest, Michael Pento. What do you think? QE3, 4, 5, 6?
Well, here's the problem. The only way the United States can maintain any semblance of solvency is because we've had these interest rates pushed artificially lower
right.
Pretty consistently now for 30 years.
Mm-hmm.
We went from Fed funds rate at 19% when we had a real central banker under Paul Volcker, and now they're at 0. And that 0% interest rate is wonderful when you have so much debt. For instance, our publicly traded debt has increased 90% in the last 4 years, yet our interest expense has declined. Thank you very much, Greenspan and Bernanke. So when rates rise, let's just assume that the shipbuilding industry goes the way of the buggy whip, and we actually start to drain the Fed's balance sheet. And I say drain for your listeners so they understand. That means that the Fed will no longer be buying 70% of all of the Treasury auction. They will be adding to supply. Now, let me see. If I take the Fed, which is 70% out of the picture, I take China out of the picture, I take Japan out of the picture, I take Europe out of the picture, what do you think happens to interest rates? I think they skyrocket.
Oh, absolutely.
And if I'm correct, that's going to reveal the overburdening amount of debt that we've amassed in the decade since we left the gold standard in 1971. I think the country becomes insolvent in a very short period of time if that's the case. So the answer to your question is, can the Fed really ever drain the balance sheet? I think the answer is no.
I agree with you 100%. And and you really think about it, when we don't need the S&P to tell us what shape our country is in. We just need to look at gold. Am I right? I mean, just look at gold. I mean that's telling us where we are financially.
It's telling you that the purchasing power of your currency is being decimated on a daily basis.
Right.
Gold doesn't really care about the Indian wedding season. Really doesn't care about how much people are buying jewelry over in India.
Right.
It cares about the depreciation in the purchasing power of your currency, and that's why it's setting all-time nominal highs almost on a daily basis.
And they're talking about bleeding us with higher taxes to fix what's wrong with this country. Are you kidding me?
Well, a tax rate increase doesn't equate to an increase in revenue. I would wish by now they would understand that.
They don't get that.
But they don't understand that. I mean, this is the way the CBO scores a budget. If I tell them that we have a tax rate that's going from 39% to 100%, they'll say, well, 100% of $15 trillion. Well, we can raise $15 trillion in revenue.
Jeez.
They don't account for any change in behavior. How silly is that, Phil? But
Yeah.
that's how they score budgets.
Yeah, instead of fixing our blood-sucking, money-sucking insurance monopolies, the stupid wars that we have over there were not there for any reason except to take care of the defense industry. I mean, yeah, you're right. I mean,
Right.
it's amazing. I mean, they don't fix what we're supposed to fix. Instead, they go and want to raise our taxes, which is
What happens when you get to Washington, Phil? I mean, the one thing I liked about Obama, the one thing he said that I really liked is that he didn't believe we had any damn business going into Iraq. They didn't have WMD,
right.
and they didn't attack us on 9/11. Right and right, check and check. So then what does he do? He spends hundreds of millions of dollars lobbing tomahawk missiles into Libya.
It's just,
I don't. Where's the consistency? I guess when you get to Washington, someone over there says, "Hey, from Halliburton or from Lockheed Martin, hey, if you want to play the game, this is what you have to do."
And that's the deal. And that's why guys like you keep giving the good information, keep telling the truth. Love having you on the show. You know what you're doing, and you're a great asset to my listeners. Thank you so much.
Thank you so much, Bill.
Okay.